Hello everyone, welcome to a new stock valuation video here on Nativitas. Today we're going to value meta platforms, and it's been a while since I've uploaded a new video. Why that is? Well, I've been really busy lately with all sorts of things, with my job, with my university, with my all sorts of stuff. So I've been really busy, but I try to upload at least once a week. So here I am back again, better than ever, with a new valuation video. And today I wanted to talk about Meta Platform, since I think it's a very unique company, since I think it is out of the Mag 7, definitely one that it is a bit different than the others, especially from a valuation and fundamentals perspective. But we'll see that in the fundamentals section in this video. First, we're gonna have to get the disclaimer out of the way. And it's not on the slide, but I wanted to say at least one thing in addition to this disclaimer, and that is that I do own a few Meta shares. It's not a major position of mine. I own about 3 shares right now as of writing this or as of recording this on the 19th of March. But that position can expand in the future. It can also shrink in the future depending on what happens in the future. But just to clarify and just to open up to you. Now, the disclaimer. The information provided by Nativity is for informational purposes only and does not constitute financial advice. The disclaimer outlines the limitations of financial stock advice and the risks associated with trading and investing before making any financial decisions. We strongly recommend consulting with a qualified financial advisor for conducting thorough research. No guarantee of accuracy. The information provided by Nativitas is based on sources believed to be reliable, but we do not guarantee its accuracy, completeness, or suitability for any purpose. We strive to provide accurate and up-to-date information, but market conditions and financial news can change rapidly. Not financial advice. The content on our platform includes including articles, analyses, and stock recommendations, is not intended to be financial advice. It is for informational purposes only. Users should not rely solely on this information when making financial decisions. Always seek the advice of a qualified financial professional before making any investment. Risk of loss. Investing in stocks and financial markets involves inherent risks. Past performance is not indicative of future results. This is not responsible for any financial loss or damages incurred as a result of using our information. Users should be aware of the risks associated with trading and carefully consider their investment objectives and risk tolerance. Individual responsibility. Users are solely responsible for their investment decisions. Nativitas does not provide personalized investment advice, and each individual's financial situation is unique. Users should consider their own financial position, risk tolerance, and investment goals before acting on any information provided by Nativitas. No endorsement or recommendation. Any mention of specific stock, securities, or investment strategies on our platform do not constitute an endorsement or recommendation. Nativitas is not affiliated with any company mentioned and does not receive compensation for promoting specific stocks or securities. Market conditions. Financial markets are subject to various factors, including economic conditions, geopolitical events, and market sentiment. These factors can impact stock prices and market trends. Users should be aware of the dynamic nature of financial markets and the potential for rapid and unpredictable changes. By using Nativitas services, users acknowledge and agree to the terms outlined in this disclaimer. Nativitas is not liable for any direct or indirect damages arising from the use of our information. Users should exercise caution and conduct their own research before making any financial decisions. Now that we've got the disclaimer out of the way, we'll go ahead and talk about what are we going to talk about in this video. First, we're going to cover the history, then we're going to talk about the business, a little bit about the leadership, and then we're going to analyze the financials of Meta platforms. So the history from 2004 to 2020. Well, Facebook was founded in 2004 from a dorm room when Mark Zuckerberg, the CEO and founder of Facebook, founded Facebook together with some other Harvard students. It filed for IPO in 2012, and eventually in 2018 to 2020, Mark had a focus on the metaverse. Now, you can think of that whatever you want, but most investors didn't like it. Now, if you look at 2021 to now, and I think this is the most important time frame from Meta, for Meta, is because this is really a time where a lot changed within the company. And that's why I'm speaking of a seismic shift. First of all, in 2021, the company was rebranded to Meta. Then after that, in 2020 year, the year of efficiency was announced, or well announced, he called it later after it, but which it resulted in a lot of layoffs, and that's also what you see in the leadership. In the leadership, a lot of new C-suite executives joined in 2022. Now, it also happened in 2023, 2024. There was a turn on to more focus on AI, especially in the advertising segment of this business, and also the start of Threads. Even though it's a small social media company, it still is a new endeavor of them and a competitor to Twitter or X. Now we've got the little bit of a history out of the way. If you want to go deeper into the history, you can of course always take a look at the Wikipedia page, but I think that the history of a company is not that essential. It's more important that we talk about the business, about the leadership, about financials, about the possible future. Sure, you need to know a little bit about the history of a company, but I don't think it is that crucial to know every little single detail of what happened 10 years ago. Now, if we talk about the business, of course, Meta Platforms has social media platforms, right? Facebook, WhatsApp, Instagram, you name it, all sorts of different social media platforms. Now, also Meta also has some augmented and virtual reality stuff they're doing, which is actually a very interesting part of the business. So we're definitely going to dive deeper into that later in the business segment. But first, let's go to their bread and butter, the social media platforms. And if you look at the most used social media platforms worldwide, we can see that Facebook is number 1, WhatsApp is number 3, Instagram is number 4, and Facebook Messenger is number 7. And as you can see, these are all pretty much the biggest social media platforms out there. YouTube is after Facebook, but I believe YouTube is something completely different. It targets a completely different market than what Facebook or Instagram or WhatsApp does. And WeChat and TikTok are, of course, the 5th and the 6th. But these apps or platforms are also mainly so big because of China. China has banned Facebook or Instagram and WhatsApp and whatnot. They've banned Google. They've banned all these American companies because they're scared of American influence. So that pretty much gives these Chinese companies a big monopoly in that country. And it's kind of just an unfair advantage that they got there. And that's also the main reason why, for example, WeChat is so big. I don't know anyone outside of China that uses WeChat. Now, TikTok is, of course, a bit of a different story. TikTok is also very, very popular here in the US, or in Europe, or in Africa, or in other Asian countries, pretty much everywhere. But if we look at Meta's businesses, we see that Meta owns some of the biggest platforms in the top 10, top 5, top 3. As you can see here, if we add the percentages, Meta owns about 40% in the top 10, about 60% in the top 5, and about 67% in the top 3 of social media platforms. So obviously Meta is a very, very big player in this field. And that also is caused by how these platforms work. For the people that don't know, the business model is a multi-sided platform. And how a multi-sided platform works is that you need a lot of users to get a lot of content creators. And you also need a lot of content creators to get a lot of users. So it's somewhat of a circle. And once you have that circle, it's very difficult to get it, but once you have it, you pretty much have a monopoly. Because it's very difficult for other people to get in your market and break your circle and get their own circle to grow, right? To get their own MSP, a multi-sided platform, to grow. So it's a very, very monopolistic, but also a very lucrative business. And that's what you're seeing here. You're seeing that one operator, pretty much, Meta Platforms, operates some of the biggest platforms out there. And, well, the result is, of course, a monopoly, quite obviously. There is one concern, and that is how Gen Z and millennials are using each social media platform. Now, this is 13 to 17-year-olds, so I just wanted to take the youngest audience because I think that's the most interesting one to look at. And as we can see, and I do have to put a bit of a side note here, is that these values change rapidly between which database you're using. For example, here we used YPulse, but if you use another one, it could be completely different. One thing that seems to be agreed upon is that YouTube is the biggest. TikTok is usually close second. And then you got something like Snapchat and Instagram on third and fourth. And Facebook is usually fifth. So you can see that Facebook is, by the way, the biggest, remember, right? Biggest. They also have are the most popular social media platform across adults, but not with young people. Young people like YouTube, young people like Instagram, young people like TikTok, especially Snapchat, but they're not very fond of Facebook. And I think that's also because of the sheer association that Facebook has with other old people. A lot of young people see Facebook as an old people platform. So they don't want to be on Facebook because it's not trendy. It's not cool to be on Facebook. What is cool is to be on Snapchat or TikTok, right? And YouTube doesn't really have that problem where they're associated with old people, despite a lot of old people watching YouTube, of course, and rightfully so. But the thing that YouTube does is completely different, right? YouTube offers free video streaming, and Facebook doesn't offer that. Facebook simply offers, well, they do, of course, offer it, but it's not their main USP, which is the main USP of YouTube. Facebook is somewhat more competing with TikTok for short form content. If you look at Facebook, we see the social media platform has more than 3 billion users. That's insane. There are about 8 billion people on this planet, and even less billion people with internet connection. So pretty much everyone who has internet probably also has a Facebook account. And as you can see, is that Facebook had been growing since 2008 when the chart began, but since then has somewhat stagnated in the 2020s, 2021. So it's still growing, but the growth is a lot slower. It goes kind of without saying, but this is obviously their most profitable business. Meta is earning billions off of Facebook each year. It's good to see that their USP, or the kind of their best product, is not declining. It is somewhat maturing, but that's not very bad to see, right? We have a lot of very mature products that are still very profitable. So I don't mind Facebook's growth stagnating too much. I wouldn't be too concerned as an investor. But just something you would have to realize that it's no longer a rapidly growing business. Then if you look at Instagram, it's their second biggest social media platform, almost after WhatsApp, but WhatsApp isn't really a social media platform. So it has more than 2 billion users and is usually just aimed at a younger audience, where Facebook is kind of aimed at, well, boomers, right? Pretty much everyone after 30, 40 years old or older than that. Instagram is kind of aimed at millennials. It's aimed to close that gap, right? It's aimed to be a little bit more of the trendy app compared to Facebook. And you see that definitely with the young people, or the usage of young people on those platforms. If you look over here, as once again, you can just look at the chart and you see that Facebook has about 44% in November 2023. Even though you see that Facebook is somewhat rising in popularity, you see that Instagram has about 55%. So Instagram is definitely more popular among young people. Now, if you look at WhatsApp, it's somewhat more of a messenger app. Also has more than 2 billion users, solely aimed at messaging. They do have some story functions, but no one really uses that, I believe. I personally just see it as a bit of a more professional application, a bit of a more professional use case. It is usually to be able to send messages to your boss, to coworkers, to your fellow students, maybe to your mom and whatever. But I think the main use case of WhatsApp is business like, and I also think that's why there are 2 billion users. And it's also because it's free, right? SMS in a lot of countries costs money, and WhatsApp is free as long as you have Wi-Fi or internet connection. So I think that's also why WhatsApp is very, very popular, especially in poorer countries. Now, I also think WhatsApp is probably one of the possible things that Meta could monetize on that would result in a lot more cash flow, because WhatsApp is currently pretty much not monetized. There are no advertisements, there are no other things that are being done with WhatsApp. There's just 2 billion users there that you can use advertising on. So I think definitely it's something that Meta could monetize a lot better, and I think they're definitely looking into ways to do that. However, it is quite difficult to do it. Otherwise, they would have obviously already done it. But also because if you look at, for example, a Snapchat, which is also pretty much a messenger app. I know it's officially a social media app, but Snapchat is very close to just being a messenger app. Is that the leadership over there at Snap is currently struggling to get some cash flow going, because how Snap is getting used is young people. They just open the app, send some messages to some friends. They look at Snap Maps. Where are my friends? Right? Where are my friends located at right now? They send some more messages. They close the app and they go to TikTok. So that's how currently Snapchat is being used. And WhatsApp is somewhat alike in the sense that people just send messages and they're not too concerned about advertising, right? So that's some way they will have to look into it. But that's up to the leadership and up to professionals, not up to me, luckily. And if you look at Threads, we can see that Threads is a very young application, by the way. It has only 160 million users, which is tiny in this space. This chart looks very impressive in the sense that it has incredible growth, right? In less than 11 days, it's more than 100 million users. Well, that's because it got promoted on Instagram and on Facebook, so it's not really fair. And 240 days after launch, or since launch, is about the beginning of March 2024. And this is about July, I believe. So, obviously, Threads is very young. It was more or less a response to Twitter or X that got acquired by Elon Musk. And Meta saw a chance there and they, jumped on that boat. Now, if it's a success, I don't know. 160 million users is not that much. I think they're losing money on it. I'm very curious to see how it will grow, but as you can see in the last 50 days or so, it's pretty much not grown. So I wouldn't be too surprised if eventually after a year or 2 years they pull the plug on this project, simply because it's unprofitable and it doesn't continue to grow. But we'll have to see. We'll never know where it goes. Maybe X somehow goes bankrupt and everyone will go to Threads. Is a possibility. Could happen. But we'll have to see. A completely different business segment, and that is Oculus. Oculus is a company they acquired in, I believe, 2016 or something. I'll put it up the screen here somewhere if I got it wrong, but otherwise it's 2016. It mainly does stuff with VR hardware. It also has some AR hardware going on, but AR hardware is a lot less popular than VR hardware. Now, and what I wanted to point out especially is this chart here. As you can see here, the Oculus Quest, which is of course the Meta Quest, or I think it's now the Meta Quest 3, is the newest variant that Meta has announced, or basically already has, is selling. Now, I must say the Meta Quest 3 looks very promising. It looks very promising. If you don't know what it is, you could look up some reviews. It's a very advanced piece of technology. It's very, very cool to see. But if you look at the market dominance that Oculus or Meta has somehow obtained. Here in 2019, you can see they're a very small part of the whole overall VR market. 2020, they're a bigger part. 2021, even bigger. 2022, even bigger. 2023, even bigger than that. So as you can see, they are growing incredibly quickly. And that resulted in Meta owning about 50% of the XR market. XR is AR and VR combined, right? And the XR market current size is about 100 billion US dollars, but forecasted size in 2030, or in about 10 years, somewhat 6 to 10 years, is to be about 2 trillion US dollars. So that's huge. That's a 20x. If Meta could own or keep their market share of about 50% in that market, and of course it's only a forecasted size, right? It's not guaranteed in any way. It could also be 200 billion in 10 years, only doubling, which is not that big of a deal. But if it could grow to 2 trillion and Meta still owns 50% of the XR market, then that is of course an enormous market that Meta is tapping into. And I think that's also the reason why Meta is investing so much into VR and AR and XR. If you look at Reality Labs, which is their metaverse segment of the business, their segment of the business mainly concerned with all VR related stuff, you can see that they're investing about $16 billion last year, $13 billion before that, 10 billion before that, 6 billion before that, 4.5 billion before that. So they're investing enormous amounts of money into this whole metaverse and whole VR project that they have going on at Meta. So they're very, very convinced that this could potentially be very profitable. Now, a lot of investors don't like this, right? This is also the reason why Meta stock was beaten down so much a year ago or 2 years ago, because they were investing so much into a very uncertain business. But I think Meta's leadership mainly looks at this number here and thinks, wow, we really need to tap into this market right now. We need to dominate this market. We need to get enormous amounts of market share right now to potentially get this 2 trillion US dollars, or if they can potentially own 50% of the market and maybe potentially get $1 trillion, hopefully. Then that would be massive. That would be massive for them, because the company itself doesn't even have that in revenue. They would more than double their revenue. Then another thing with their business is a possible TikTok ban. Now, Meta is an unlikely bidder. If TikTok gets banned, it needs to get sold to a US company, simply because lawmakers wouldn't allow it for monopolistic reasons, right? I think that's quite understandable. There are a couple other companies that could potentially buy TikTok. Think of Microsoft, think of an Oracle, even though I think Oracle is not that realistic given their financial position, or perhaps even a Google. It could all possibly be, but Meta is very unlikely, and I also think, even though the TikTok leadership said they would rather ban it than sell it, I think they will sell it. If it eventually gets to it, they will of course sell it. And I think Meta isn't that big of a beneficiary of this whole ordeal. I think if, of course, TikTok got banned, then of course that would be massive. But TikTok is very likely to just get sold. And in that case, Meta is very unlikely to be disrupted or unlikely to even gain any users. Maybe a couple, but not any notable amount. So I don't see it as very, even though it's in the same space as Meta, I see it as very unmoving, actually. So if we look at the business, good points are many large social media platforms, many large MSPs, of course, which are very monopoly-inducing, and also strong growth in the XR segment. Concerns, Gen Z trends, because of course Gen Z is more going towards TikTok and Snapchat. Possible Apple AR disruption could be. I don't see it as a major concern, but it's still something to keep in mind. And of course, the profitability of XR is still in doubt because they're still losing money, a lot of money on VR and AR and whatnot. So Meta platforms and their leadership. If you have a quick overview, The CEO is Mark Zuckerberg, CFO Susan Lee, COO Javier Olivan, CPO Chris Cox, CTO Andrew Bosworth, CLO Jennifer Newstead, and CSO Dave Wiener. Now, we're going to take a deeper look into the CEO, CFO, the COO, and the CTO, because I think those are the most notable ones. So we're just going to have a deeper look into those. Mark Zuckerberg. Mark Zuckerberg is the Chief Executive Officer, also the founder of Meta or Facebook. He's about 39 years old, which is still very young for a Chief Executive Officer. He studied psychology and computer science, but he was a Harvard dropout, so he never finished his degrees. Now, his hobbies are MMA fighting, surfing, and since this summer pretty much, racing cattle on his Hawaiian resort. So he has a wide variety of hobbies that you wouldn't very quickly think of when you think of a tech CEO, but you know what, Mark, you go for it. It's whatever you like to do in your free time or in your spare time. But he's a CEO, he's infamous for being socially awkward, for being a bit weird, for being a bit geeky or nerdy. But I think overall he's a very good CEO, and he's definitely shown that in the last 2 years. He's definitely shown that he can run an efficient, good, strong, high quality business. And that is something that we like to see more as investors. That's far more important, at least to me, than to his weird side or to his nerdy look or whatever. All eventually investors care about is to see money and dollar bills, and whoever runs the company just has to be very qualified. And I think Mark Zuckerberg is very, very qualified. He's had enormous experience as CEO of Meta. He, of course, is very intelligent. And I also think that's a very big plus for a company to still have their founder around in the company somewhere. And to have your founder as the chief executive officer, well, of course, that's just a big bonus. That's tremendous, right? Because usually a CEO that was the founder has somewhat of a sentimental value with the company. They want the company to do really, really well because they kind of view the company as their little child. So I think that's a very big plus. It's a very big bonus to see. And I'm very positive on that. Now, the CFO is Susan Lee. Susan Lee is the Chief Financial Officer, 38 years old, promoted to CFO in 2022, joined Meta in 2008, and now has over 19 years of experience. Before 2008, she also worked as well at Wells Fargo, I believe, also in a financial position. Now, she joined in 2008 and was promoted in 2022 because in 2022 was the year of efficiency. So a lot of old folks got laid off and a lot of new C-suite employees got put in their positions. And Susan Lee is one of those. Also, Susan Lee is very, very young. 38 years old as a CFO is very young. But I don't necessarily see young as very bad in this sense, because it's a social media platform. It has to connect with young people. And of course you don't want to hire 20-year-olds or fresh college graduates. You want to hire some people with experience, but not people that are too old that they kind of don't feel the young people anymore. You know, you want to have young people with a lot of experience, and I think for 40 years old is somewhat the sweet spot. Now, of course, this isn't an industrial company. It's not a 3M or whatever. Then, of course, experience would rule. But in this sense, I think having a bit less experience in exchange for having a bit of a younger C-suite is definitely a positive thing, keeping in mind the business that Meta is in. So if you look at the COO, the Chief Operations Officer is Javier. I think it's Javier Olivan. He's 47 years old. He's also one of the oldest of the C-suite. He was promoted to CEO in 2021, so once again promoted in the year of efficiency, and joined Meta in 2007. He has around 20 years of experience, and just like Mark, he also really likes surfing. Andrew Bosworth is the Chief Technology Officer, 42 years old, promoted to CTO in 2022, joined Meta in 2006 and also has about 20 years of experience. So when you look at the young C-suite, right? When you look at this young C-suite, it's somewhat comparable to ByteDance. So it's very common with these tech companies, but especially with these social media platforms, to have a very young C-suite. And as I already explained, I see that not necessarily as a bad thing, I see that as actually a positive thing. The C-suite got enormously changed in 2022, the year of efficiency once again. A lot of old folks got laid off and a lot of new folks came in, giving a fresh, new perspective to the company. And well, from the past experience, we can definitely determine that it was a very, very good move. The founder is still active in the company, which is also a very positive thing. Now, the Meta platform's financials. And this is kind of like the fun thing, right? This is something that we really like to see. It's something more interesting to a lot of investors. I think you definitely do have to need the qualitative analysis that we just had, but now we're going into the quantitative, and this is usually the part that most investors really like because it's talking about money. So we're going to talk about the income statement, balance sheet, and cash flow statement, and then we're also going to cover some ratios. And then we're going to talk about DCF model, multiple valuation, and analyst valuation. And we're going to take an average of that. And well, that average is going to be our valuation of the Meta stock. So if we look at the income statement, what do we see here? Well, the income statement provides us with a couple of insights, but I think the most interesting one actually is the revenue growth. Because if you look at the revenue growth, you see that it's somewhat growing linearly. However, here there was a big jump. But if you remove 2021, 85, 116, 134, you see that it's actually somewhat linearly growing. So I decided and took the liberty to take the revenue from 2016 all the way up to 2023, and I found this line. So as you can see, it is linearly growing. However, in 2021 there was a large spike. That was mainly due to the corona pandemic, a lot of people being inside, a lot more users, a lot more hours spent on social media. But once you remove this outlier, you get a normal revenue linearly grow. Now, of course, the orange line here is the linear growth, and the revenue is the blue line. This is the actual revenue. And it is linearly growing. So that's actually very good to see, because what does it allow us? Well, it allows us to somewhat extrapolate this, and that's by no means accurate, but then we get this data. So if we extrapolate that data, and we take it to 2028, we see here that in 2028, in about 4 years, possibly Meta could be above $200 billion in revenue, which is an enormous number, and is by no means accurate or reliable, but just, yeah, I think it's a very interesting thing to look at, because this, well, it grabbed my attention. I saw it and I was like, wow, this is very unique. What else can we see? Well, not too much of interesting stuff. You can see that definitely in 2023, a lot of things got increased a lot. Growth of 16% in revenue, 90% gross profit growth, operating income growing tremendously, 62%. And what was very interesting with the operating income was that actually revenue grew a lot, but R&D expenditure very little, and SG&A actually decreased. So that was they were definitely cutting back on some operating expenses. Also, COGS was actually the same as the year before, or somewhat the same. So you definitely see them cutting a lot on costs there. And that, of course, resulted in our net income being 70% higher, which is tremendous growth. That's tremendous. Earnings per share also growing a lot. So if you look at the P and the PEG ratio, P of 32.55, forward P of 24.04, and the PEG ratio of 5 years. If you compare that to the rest, because of course these things you have to compare, we see that Meta, out of all the publicly traded social media platforms, is by far one of the best. Just from these three metrics, which is by no means accurate, just from these three metrics, I think Meta is the solid bet here. If you compare it, of course, to other companies outside of social media, comparing it to other Max 7 stocks, you could see here that Meta is still very, very a good buy. If you look at the PE ratio, it's pretty much the third in line. Forward PE is pretty much the second, and the PEG ratio is pretty much the best. But we're going to go deeper into this in a couple of slides, and then I'll show some very interesting insights. So first we'll have to look at the balance sheet. If you look at the balance sheet, it's a very unique thing we're seeing here. I've never really seen such a balance sheet that had a current ratio of 5.05 in 2020. That's insane. The current ratio of 5.05 is incredibly high. So I'm definitely not too concerned that it pretty much got half to 2.67. I don't mind that too much because 5.05 is simply way too big. Because what that indicates to me is that the company doesn't know where to invest their money. They had about $62 billion in cash and equivalents and only about $30 billion in liabilities. So that tells me that the company doesn't know where to invest their money. So them decreasing their current ratios a bit is not too concerning to me because 2.67 is still very high. Debt to equity of 0.5, still very good. It's definitely grown, but it's still very good. Working capital, 53 billion. Insane. That's an insane number. Asset turnover, 0.65. Still very good. Asset turnover in 2020 was 1.08. So they had more revenue than they had in average assets. This is an incredibly unique balance sheet, incredibly healthy. Too healthy, you can almost say. So they've kind of taken this balance sheet that was too healthy in 2020 and made it a bit less healthy in 2023. Invest in some projects, do some stuff on the side, try to grow the company and invest in stuff. And I think that's a very positive thing to see. So I don't see these developments as necessarily bad. I see them actually as very good developments, that they are slowly investing more money into projects and whatnot. So I think the balance sheet, and overall the balance sheet in 2023 is still very healthy. Very, very liquid, as everyone knows. Liquidity is far more important for a company than profitability. I think it's by far the most important metric any company can be good at, because if you have no liquidity as a company, you're going to go bankrupt. So very important, and Meta Platform is just as liquid as ever. So very, very good. Look at the cash flow statement. We're just going to quickly cover this. As you can see, free cash flow is just growing tremendously well, and operating cash flows are just growing. They're investing a lot more, and they're also financing a little bit. Overall, free cash flow per share, $17, very good. I think the Meta is doing very well here. Not much concern. Capital expenditure has grown, of course, because they're investing a lot more in data centers, into AI and whatnot. So I think it's very reasonable that they're investing more into CapEx. And actually I also like CapEx, because CapEx is usually an investment for more than a couple years, usually even 10, 20 years. So I think it's an investment into the business to have more reliable growth in the future. So I really like CapEx expenditure for that, or capital expenditure, sorry. So overall cash flow statement just looks very good, very healthy, very liquid, the same as the balance sheet. So just looks very good. Then the important ratios, if you look at the enterprise value, 1.2 trillion, free cash flow 44 billion. And cash flow from operations is 71 billion. If you look at enterprise value to free cash flow, it's 28. Enterprise value to cash flow from operations is 17. And of course the PE, forward PE, and the PEG ratios. If we actually compare this to the rest of the Mag 7, and I've done that for you guys, I've compared Meta Platforms' ratios and values to the rest of the Mag 7, and you can see here in the best value chart that actually Alphabet is the winner. Alphabet has by far the best metrics. It has the best cash flow from operations, the best free cash flow from compared to EV, the best PE, the best forward PE. Only the PEG ratio Meta is winning at. All the others, not so much. Now, is that a major concern? No, because these are just metrics that you have to put or take into consideration in addition to other things that you're taking into consideration. And I think Meta Platforms definitely has a lot more growth than Alphabet. Alphabet has about projected 15% growth annually, at least earnings. And Meta's earnings are expected to grow at about 25 to about 20% annually. In my DCF, I've taken 25% for the first year and then 15% for the following 4 years after that. I think Meta has a lot more growth than Alphabet. Okay, in the of the Max 7, I think both companies are definitely value growth companies. And if you also take a look at my previous Alphabet valuation video, if you guys want a new one, by the way, I would definitely like to make a new one. But if you look at my previous Alphabet video, it shows Alphabet fundamentally has a very solid business. Good balance sheet, good income statement, good cash flows, very little expenditures, very profitable, very overall just a very good business. So the fact they're winning at best value just from the ratios is not too surprising. Meta Platform is second, and that's very good. That's still a very good company. And especially the PEG ratio is very appealing to me, because a PEG ratio of 1.10 is not too bad. You'll preferably want one below 1, but Alphabet was that a couple months ago for a while, but not anymore. And usually these very large companies, they have a lot more safety in terms of growth and whatnot. So their PEG ratio tends to be a bit higher than, for example, other companies, smaller companies. So PEG ratio of 1.10 is actually not too bad. Also, it's of course not by any means the most important metric. It gives a lot of insights, very valuable as a ratio. I think it's, of all the ratio, it's one of the more interesting ones to look at, but it's definitely not a end-all be-all, and it's something you take into consideration as well. Now, if we look at the valuation and we look at the DCF model, basically concluded that the DCF model gives me an implied share price of $620, and I used a growth rate of about 20%. I used about 25% in the first year and then 15% after that, and I projected for about 5 years. I think it's a very conservative growth rate, especially if you look at the whole XR market thing going on, the whole TikTok uncertainty. I think that 20% growth in earnings is not too positive. I think it's actually a very conservative growth rate. Also, if you look at the previous growth rates per annum, I think it's a very, very, well, conservative, very reliable number to pick, giving us a $620 valuation, and that means it's 22% undervalued at the current price of $484. Now, if we get a multiple valuation and we compare to Pinterest and Apple, I just picked Apple because I see it as a very mature tech company, and I think Meta is somewhat approaching that stage. We see that Meta is undervalued about 11%. If you take the valuation of Pinterest, the multiple that they're using there, 27, we get an implied share price of 550, and with Apple 533. And if you take the average of these two numbers and we apply that to our share price, we get 541. So that's about 11% undervalued. If you take the analyst valuation, Yahoo's Finance, they say 504, Alphabet says 514, Value Investor 318, and I was actually contemplating, should I really use this number from value investing, because it's so low, it's very much just an outlier. But then I thought to myself, well, it's not too bad to have a bit of a conservative bet in there, just to make our valuation a bit more reliable, in the sense that it's a bit more conservative than that we're just only looking at the very positives. And I would rather be on the safer end than be on a more riskier end. Even though the more riskier end could be more reliable, I would say let's just pick the more safe option here. So I added 320, 565, 424, and the average eventually from that is 465. Now, if you take the average of our DCF model, the multiple, and the analyst, we get 542, which is 10% undervalued at 484. So there's definitely some upside according to these valuations. I'm not saying that there definitely is upside, that it's definitely undervalued. I'm just saying that that is the implied share price from our valuation here. And of course, this is by no means an accurate or reliable number that you should solely base your whole analysis on. So if you determine a verdict, if we eventually announce our verdict, we can definitely say that Meta has a new leadership, but founders still present, and just a very good leadership overall. Good growth projection, solid fundamentals, second best ratios out of the Max 7, and overall just a very high quality company. Very solid, and I think it would be a very logical pick to pick if you want to invest in big tech this year. So thank you all for for watching. This was the video. I'm going to end this video with another disclaimer. But overall, I would like to thank you guys for watching and listening to me. I hope you guys subscribe, like if you found this video very helpful. And I'll see you guys hopefully in the next one. Thank you very much. The information provided by Nativities is for informational purposes only and does not constitute financial advice. The disclaimer outlines the limitations of financial stock advice and the risks associated with trading and investing before making any financial decisions. We strongly recommend consulting with a qualified financial advisor for conducting thorough research. No guarantee of accuracy. The information provided by Nativities is based on sources believed to be reliable, but we do not guarantee its accuracy, completeness, or suitability for any purpose. We strive to provide accurate and up-to-date information, but market conditions and financial news can change rapidly. Not financial advice. The content on our platform including articles, analyses, and stock recommendations is not intended to be financial advice. It is for informational purposes only. Users should not rely solely on this information when making financial decisions. Always seek the advice of a qualified financial professional before making any investment. Risk of loss. Investing in stocks and financial markets involves inherent risks. Past performance is not indicative of future results. This is not responsible for any financial loss or damages incurred as a result of using our information. Users should be aware of the risks associated with trading and carefully consider their investment objectives and risk tolerance. Individual responsibility. Users are solely responsible for their investment decisions. Nativities does not provide personalized investment advice, and each individual's financial situation is unique. Users should consider their own financial position, risk tolerance, and investment goals before acting on any information provided by Nativities. No endorsement or recommendation. Any mention of specific stocks, securities, or investment strategies on our platform do not constitute an endorsement or recommendation. Nativities is not affiliated with any companies mentioned and does not receive compensation for promoting specific stocks or securities. Market conditions. Financial markets are subject to various factors, including economic conditions, geopolitical events, and market sentiment. These factors can impact stock prices and market trends. Users should be aware of the dynamic nature of financial markets and the potential for rapid and unpredictable changes. By using Nativities services, users acknowledge and agree to the terms outlined in this disclaimer. Nativities is not liable for any direct or indirect damages arising from the use of our information. Users should exercise caution and conduct their own research before making any financial decisions.